I think in a post-COVID world, we've had an unlimited credit card of government spending to make sure that we dealt with the pandemic. We've done $5 trillion of stimulus, and we haven't paid for any of it. Now we're at a new turning point here. We've put forward a new spending plan yesterday, and it's going to have a lot of spinach. And so the way that I like to talk about it is, we were doing a lot of candy, no spinach. Now we're getting some candy, and we're starting to get some real spinach here with these tax increases. And so we have to say to ourselves, what is the net effect of not just this plan, but there's another one coming on April 12th or April 19th. That's going to be another series of spending and tax increases. And what does that mean for the U.S. economy moving forward? And I would argue that we're going to see more tax increases than government spending based on that plan that we saw yesterday. The infrastructure spending the secretary was just talking about has a very long lag time to be spent. It takes years for that money to come out. We learned that with Obama in 2009, but that's really been true for the last 50 or 60 years in the United States. And the tax increases are immediate. And some of these tax increases, while they may look manageable, you're talking about $1 trillion on U.S. multinational foreign income. You're talking about almost $2 trillion of tax increases over 15 years. And that's going to impact earnings per share on S&P 500 companies. That's going to impact competitiveness. And overall, I think it's going to be a net drag to the U.S. economy, both in 2022 and 2023, all else being equal. Now, there could be a situation where members of Congress delay some of those tax increases from coming into effect because they're worried about those tax increases in a midterm election year. But even if those tax increases don't come into effect, we're probably still going to see a fiscal drag just because we did almost $3 trillion of stimulus this year. And that's going to be very hard to replace next year. Now, when we look at the actual spending, where is that spending focused? Well, $115 billion is on highways of the $2 trillion. That's the traditional infrastructure in Washington. And there may be some good reasons to do grid modernization and have a utility CapEx cycle, which is probably going to come and benefit industrial stocks. I do think that there's going to be a continued push for renewable energy. We're talking about almost $200 billion for charging stations of EVs. This is going to have an impact, and it's going to benefit the companies that are in that area. But there will be fewer companies that get that money than companies that get tax increases. And overall, this is going to be a net drag to the U.S. economy, at least in the short run, Joe.
In the short run, that's the question, because that's not the way it's being exactly sold. One point. So for how long? How many years will it be a drag before it starts paying off, if it ever does?
We'll know more once we see the Biden budget and the way they lay that spending out. But rule of thumb, Joe, is that for every dollar allocated on infrastructure, only 20% come out in the first year. So they're arguing that they want to do about, $200 billion per year in infrastructure, somewhere in that range. And so you take 20% of that. That means you get about $40 billion in the first year. You'll get $80 billion in the second year. So it takes a couple of years for it to really ramp up and get to the level that's actually being authorized. And the reason that happens is you got to plan, you got to get permits, you got to do the site designs, the architecture. All that stuff takes a lot of time. And by the way, it may increase productivity over long periods of time, but don't think that you're going to see this money immediately in 2022. And even in 2020.
I don't know if we have time to go into your calculation of the taxes on corporate income and what it goes up to, but that's a disturbing number, 62.7, the highest in the OECD. And
that's correct.
That can't help, can it?
No, it doesn't help at all. I mean, look, it's one thing to say, okay, we're going to raise the rate to 28%, but you're also raising the dividend rate to 40%. And so that means the effective tax rate on profits is almost 70%. It makes the U.S. totally uncompetitive.
Shepard Smith here. Thanks for watching CNBC on YouTube.